The preliminary GDP for the fourth quarter suggests the UK economy has entered a technical recession. Hello and welcome back to our channel. My name is Daniela. In today's video, we are going to be looking at the latest growth data from the UK because it does suggest that the UK economy has entered a technical recession in 2023, as both the third and fourth quarters have shown negative growth. But before we get into it, please like this video, comment, subscribe, and turn on your notifications. And as always, if you have any questions or suggestions, please leave them in the comments section below and we'll try to get back to you. So the preliminary GDP reading for the fourth quarter released this morning has shown a contraction of 0.3% in the UK economy, which is actually bigger than the 0.1% expected. So suggesting that the UK economy was worse off in the last three quarters of the year than markets were anticipating. And this does follow on from a 0.1% contraction in the third quarter, which altogether 2 quarters of consecutive negative growth is viewed as a technical recession. Now, in terms of the makeup of this data, all three of the sectors in the UK have shrunk in the third quarter: services, production, and construction, with construction taking the worst hit, contracting 1.3% in those last 3 months of the year. Now, all in all, this data does put further pressure on the Bank of England to try to balance the growth prospects as well as inflation. And comments from Chancellor Jeremy Hunt have said that the biggest barrier to growth in the UK remains to be inflation, that is not allowing the Bank of England to cut rates and therefore remaining or keeping financing costs high and elevated, which is a barrier to growth in the UK economy. In terms of the Bank of England, the data likely doesn't change that much in terms of the decisions, the immediate decisions from the Bank of England. We have seen in markets that after the GDP data release, the basis points implied for this year in terms of cuts have increased. Markets are now pricing in around 75 basis points of cuts this year. That has risen from 70 before the data. So we are seeing markets adjust their expectations a little bit on the back of this data. But as I said, it just really makes the balancing act hard for the Bank of England. When we've got now a technical recession and we've got stagnant growth, but at the same time, inflation remains elevated. Data released earlier this week showed that CPI remained unchanged at 4% in January, and therefore showing that inflation remains elevated. It is important to point out that CPI did come in actually below expectation, defying forecasts of another uptick at the beginning of the year, like we saw in the last 2 months of 2023. So that data coming in slightly below expectations did give markets a little bit of a positive sentiment towards the UK assets, specifically the FTSE 100. And we'll see on the charts in just a second how the pound and UK stocks have been reacting to this data. But we've seen quite a lot of information coming out this week. First of all, we started with slightly higher wages than expected, suggesting that the labour market remains tight, followed by that lower than expected CPI, but nonetheless still remain elevated. 4% is double the long-term 2% target from the central bank, and then followed on from this weaker than expected growth data. As I said, just putting a lot of pressure on the Bank of England. It is making it hard at this point to try and forecast what to expect from the central bank. On the one hand, the growth data suggesting that the bank should start to consider cutting rates in order to avoid further weakness in the economy. But at the same time, with inflation remaining elevated, it's really hard for these central banks to start cutting rates. And if you compare, for example, what we're seeing in the US, we have a complete different picture, because in the US, yes, we do still have elevated inflation, but growth remains very resilient. In fact, it surprised many economists in 2023, coming in much higher than forecasted. So the central bank, the Federal Reserve, has a lot more wiggle room to act. In the UK and also in the Eurozone, we just don't have that space. We don't have that margin of error right now. So markets are starting to get a little bit nervous about investing in UK assets, because it just seems like a little bit of a tricky situation to kind of achieve, if you may, a soft landing, which seems to be so evident in the US. It's becoming harder and harder in the UK. The situation is a little bit more dire over here, and therefore markets are finding it hard to price in exactly what the central bank is going to do. If we're looking at current expectations, we are looking at the first rate cut to come between June and August. We're looking around 16 basis points priced in for June, 29 priced in for August. So that may shift. So we could see potentially the first rate cut coming in June. Markets currently pricing in a 46% chance of that happening versus a 20% chance of it happening in May. So it's pretty much a done deal that we will not see any rate cuts in March. As I said, inflation still remains elevated despite coming in slightly below expectations. But it is going to be harder and harder to kind of forecast exactly what the central bank is going to do, because also we know that the last bit of the disinflation process usually is the hardest one. And we saw at the end of 2023, it's not a linear process. We do have upticks in inflation that happen along the process. And the central bank, the Bank of England, really can't afford to cut rates while the disinflation process is still underway, and it's still not confirmed that the long-term target will be achieved. Okay, so let's kick it off with the pound. Let's look at pound dollar cable. Capital.com via trading view. And as you can see, we've resumed that weakness that we saw at the beginning of February. Now, a lot of this pullback actually coming on the back of a stronger dollar. We did see higher than expected CPI in the US, which allowed the US dollar to recover some of the bullish momentum that it's seen so far since the beginning of this new year. Of course, this pushes back on the need for rate cuts from the Federal Reserve. As I mentioned, the Federal Reserve in a much better position compared to the Bank of England, which suggests that positive data does allow them to push back on cutting rates. Not so clear, this relationship in the UK, as I said, a little bit more of murkier waters for the Bank of England with the latest data. And therefore, it's harder for markets to anticipate exactly how the central bank may react. But that stronger dollar weighing on cable, but also, as I said, this weaker growth data and also the weaker than expected CPI data yesterday has actually increased bets that the Bank of England could cut sooner rather than later. By no means does this suggest that the Bank of England will start acting immediately, but it has brought in about 5 more basis points into the expectations for this year, which that alone weighs on the pound. It weighs on the carry trade value of the pound. And at this point, and for the last 6 months, it's been, especially in the currency market, it's been a playoff between how central bank policy has been able to adapt to the latest conditions. As I said, with the Federal Reserve expected to have more wiggle room and potentially hold on cutting longer than the Bank of England, we're seeing that carry trade favor the dollar over the pound. And just generally, the negative sentiment that we've seen in the UK economy, especially with this latest GDP data, just weighing on UK assets, weighing on sentiment around the pound. So we do have that bearish trend continuing. You can see here the RSI is firmly below that 50 midline, so it's suggesting that bearish momentum likely to continue. We've also got it trading below some of its key moving averages and actually just crossed below its 200-day simple moving average, which has acted as key support in the past. So the setup is suggesting further weakness in the short term, but there really isn't right now, I think, any real appetite to be a pound seller either. Even with the weaker data that we've seen today, we're struggling to find that consolidated bearish momentum. Sellers are struggling to get the upper hand after the significant pullbacks that we've seen this week. So again, we are seeing a good amount of support in the short term. So not quite a clear direction just yet on where we're going for this, but it does suggest that the path of least resistance is lower. Let's take a look now at the UK FTSE, because we're seeing a complete different picture here. We're seeing UK stocks actually recovering some bullish momentum. They have been the clear underperformer in the last few weeks, as we've seen the likes of the S&P 500, the Nasdaq, even the DAX in Germany hovering around their recent highs. We've seen the FTSE pull back significantly over the last 7 or 8 days, recovering that momentum yesterday when we saw that weaker than expected CPI data. and also today building on those gains on the back of the weaker GDP data. Now, a lot of the pullback here on Monday actually coming or earlier this week coming from that stronger wages data. Now, as I was saying, the data does suggest that the Bank of England could potentially start cutting soon. As I said, not necessarily immediately, but the fact that the UK economy is showing signs of struggle could entice this Bank of England potentially to consider cutting sooner rather than later. And that has breathed in some positive momentum for UK stocks. The fact that we could see lower rates would induce more growth in the UK economy. And that is essentially what is driving this bullish rally in the FTSE. Nonetheless, there is significant weakness in the FTSE's momentum. The RSI still remains below the midline. We've seen the momentum today finding firm resistance here along the 50-day moving average, just around 76.09. So even though we are seeing a reversal in momentum, I think, again, the path of least resistance remains lower for the FTSE. We're just really not seeing buyers rushing into it, even when we're seeing other other equity indices pushing to all-time highs. That is it for today's video on the UK economy. Thank you so much for watching, and don't forget to subscribe to our channel.